Okay, picture this. You walk into your bank, right? A place you trust with your hard-earned money. Maybe you're just there to use the locker or check on a deposit. But before you know it, a super friendly relationship manager is telling you about this can't miss investment opportunity. It sounds amazing, but what if that advice isn't really for your benefit, but for theirs? Well, that's the hidden danger we're diving into today, the surprisingly widespread practice of bank mis-selling. Sound familiar? I bet it does. That friendly manager, that supposedly lucrative deal, they paint this perfect picture of high returns. But you have to wonder, what's just outside the frame? Are they really truly looking out for you?
And that really is the big question, isn't it? Is their advice actually about building your financial future, or is it all about hitting their targets and boosting their bottom line? As we're about to see, that line between advisor and salesperson, well, it's gotten dangerously blurry.
Now, this practice has a name. It's called mis-selling. And it's a quiet, but honestly, a pretty serious danger lurking in the world of personal finance. So let's break down exactly what it is and then get into just how big this problem really is. So let's be super clear here. This isn't just about getting some bad advice. No, mis-selling is more like a doctor prescribing you medicine for the wrong illness, just because they get a kickback from the drug company. It's the act of deliberately pushing a product on you that has nothing to do with what you actually need. You might be thinking, okay, this probably happens sometimes, at a few aggressive branches. Well, let me tell you, the data tells a very, very different story. And frankly, it's a surprising one. Just look at this number for a second, 61.74%. According to a recent survey, that is how often mis-selling is happening in India's large private banks. Think about that. It means that more than 6 times out of 10, the advice you're getting might be totally compromised. And it's not just the big players. As you can see from this data, this isn't an isolated issue at all. Whether you're dealing with a huge private bank, a public sector bank, or even a small finance bank, mis-selling is a systemic problem. It's happening pretty much everywhere. So you're probably wondering, what does this actually look like? How are they doing it? All right, to protect yourself, you've got to understand the game. You need to know the tactics. So we're going to open up the mis-selling playbook. Once you can recognize these plays, you're going to be in a much, much better position to defend your money. So these are the 6 most common plays. First up, promising guaranteed high returns. That's a huge red flag in the investment world. Second, pushing products that are just wrong for you, like selling a complicated insurance plan to a 30-year-old who really just needs a simple retirement fund. They'll also bundle things, illegally telling you that you have to buy an insurance policy to get that loan you want. And of course, watch out for the classics, hiding fees and charges in the fine print, creating fake urgency with limited time offers, and even, get this, offering to share their commission with you just to get you to sign. But why? Why would these trusted institutions operate this way? To really get that, we need to do what they always say, follow the money. And we need to look at the immense pressure cooker environment that's been created inside the banks themselves. The story doesn't actually begin with some evil corporate greed. It starts with the individual relationship manager, the RM. They are often caught between a rock and a hard place, trying to do the right thing for the customer while also just trying to keep their job. An incredible 84%. That's how many bank relationship managers say they feel intense pressure from their bosses to sell, sell, sell. This isn't just about a performance bonus. It's a culture where ethics can easily take a back seat to pure survival. I mean, look at these numbers. Beyond that general pressure, you have nearly 60% facing targets that are totally unrealistic. Over 57% are explicitly told to sell at any cost. And more than half are literally afraid of being fired if they don't hit their quotas. Now, this isn't an excuse for what they do, but it is a powerful explanation for why they do it. So while the pressure on employees is how it happens, the real engine driving this whole system is profit. We're talking massive profits from commissions on things like insurance and mutual funds. For banks, this isn't a side hustle anymore. It's a fundamental change in their entire business model. This chart is pretty staggering. Just take a look at IndusInd Bank as an example. Back in 2004, commissions from these kinds of products made up just over 3% of their income. Fast forward 20 years to 2024, that number has skyrocketed to over 22%. That shows a massive strategic shift, moving away from traditional banking and toward a sales-first model. And here's where it gets even trickier. What happens when the insurance or mutual fund company being pushed on you is actually owned by the bank itself? This creates a huge conflict of interest. I mean, are they recommending the absolute best product on the market for you, or just the one that makes the most money for the parent company? This chart right here tells the whole story in one image. In fiscal year 2024, 100%, let me say that again, 100% of the insurance commissions earned by Kotak Bank came from its very own group company. When the incentive is that strong, the customer's best interest can get lost in the shuffle really, really easily. Okay, so that's the problem and the reasons behind it. It's a bit grim, I know, but here's the thing. Knowledge is power. And now we get to the most important part of this whole thing, what you can do about it. It's time to talk about your rights and how you can build a shield to protect your finances. Now, these are not just suggestions, these are your legal rights, backed by India's top financial regulators, the RBI and IRDI. You have the right to clear, honest information, the right to products that are actually suitable for you, and, this is a big one, the right to see everything in writing before you ever sign. And for insurance, remember this crucial one. You get a free look period of 15 to 30 days to cancel, no questions asked. The bank is on the hook for what it sells you. And if you feel like you've been a victim of mis-selling, don't just get frustrated. Take action. This is the official path to get things sorted. Start with the bank's own grievance officer. Make sure you get a complaint number. If they don't solve it in 30 days, you escalate it to the RBI ombudsman. For insurance-specific issues, you can go straight to the insurance regulator, the IRDAI. And your final resort is always the consumer courts. These systems are there to help you. So we've looked at the tactics, the motivations, and your rights. What's the single most important thing to remember from all of this? It really is that simple. The most powerful tool you have in this entire ecosystem is knowledge. It's about being alert, asking the tough questions, actually reading the fine print, and never ever feeling pressured to say yes to something you don't fully understand. And that's what I want to leave you with. Look, this isn't about distrusting everyone at the bank. It's about being an empowered, informed consumer. So think about it. The next time you're offered one of those amazing opportunities, what questions are you going to ask to make sure it's amazing for you and not just for the bank?